So what are the important issues when you're thinking about how you're investing for your retirement? The first one is, how long do you need the money to last? So the fear of running out, or FORO as it's called. What you need to do is to make sure you haven't run out of money in your early 90s and you're still relatively fit and healthy, and you have to move to the state pension, because the state pension, as we mentioned earlier, is not particularly generous in this country. Secondly, you've got to look at, well, how much can you earn on your investments? Again, it depends on what you invest in and how much risk you want to take. If you look at the equity markets, typically generate more income and more capital gain than, say, fixed interest markets or property over the longer term. But, it's, if you wanted to buy an annuity, as I mentioned earlier, you'll get a relatively low but guaranteed income. If you want to take some more risk, you can obviously generate more income, but there is a risk that your capital may change. And then the third point there, which is probably the major point, is what effect will inflation have? So, over a period of, let's assume inflation, it was at 7% a few years ago. Let's say it stays at 7%. That means every 10 years prices double. And if you're on a fixed income from your investments, that means your spending power is halved. So you do have to think about how inflation might affect your spending power over the long term. And we're talking, 25 to 30 years. So, what will happen? How much would you have to spend in 30 years' time to buy a cup of coffee? It's $4 today. It could be $10 in 30 years' time. That's probably not the major one to think about. It's more, what will healthcare cost and aged care cost in 30 years' time? Because that certainly has been rising at a rate higher than the CPI, than the average inflation rate, and is probably likely to continue. So you need to make sure you have some process in your investments where your income is going to grow at least by inflation. And then the last point is, as I mentioned, how could your retirement change if market moves? So in other words, equity markets go up and down, fixed interest markets move. It's what the market, or what people in the retirement industry call the sequencing risk. So I'll touch on that slightly later, because it's a fairly important issue, and it's not one that's got an easy solution. But you do have to think about, if you've got a lot of money invested in equities, and equities values drop by 25%, how does that affect your income from your investments?